Hello, everyone, and welcome to another edition of Thrive and Achieve with your host, Dr. Matt Markle. Thrive and Achieve is the only podcast where professionals help professionals to succeed in career and wealth. Now, here's your host, Dr. Matt Markle.
Awesome. We are talking with Boris Blum, and I want to pivot now into the wealth aspect and the financial aspect of your expertise. You founded a group called Wealth Council. That sounds great. Everybody wants to be a part of the Wealth Council, it sounds like. It's a really fantastic name. What does that group do, and what was your inspiration for forming it?
Yeah, so where it came from was I was involved in a networking organization that there was this common thread amongst all of the members and the conversations that were going on. And it was always this discussion of what we'll call generational wealth. And so I participated in a lot of these conversations, and I was fortunate enough to have worked with very successful and wealthy individuals in my lifetime. So I intuitively understood what generational wealth meant, at least to me in my context. When I talked to these individuals in this organization, they clearly had no concept of this. They were completely off the mark. Like there was no clear picture of what generational wealth was. And when I asked them to describe it, they generally were trying to describe something completely different, more attuned to financial independence, right? And clearly they were all struggling, the vast majority, in accomplishing financial independence. So I said to myself, with my background, I was looking for an impact project, and this became the impact project. I said to myself, with my background, I think I might be able to help these people, but I don't know enough about the problem. So I decided to interview them. And I went out and probably interviewed well over 100 people. And we just had conversations just like this. And I would ask them invariably, what is it you're trying to financially accomplish in life? And they never described anything that sounded like generational wealth. It was always something that was financial independence driven. And I said, well, what's your definition of financial independence? Can you tell me? And they would describe it. And I'm like, geez, this person doesn't really fully understand. So I would share with them my personal view. And I said, I define financial independence as somebody who has accomplished 3 non-correlated income streams that are not derived from their professional pursuits. So if you're a lawyer and you've got 3 income streams, maybe it's real estate investments in the markets, whatever it might be, then you're probably financially successful and you don't have to worry too much about financial independence. But the vast majority of people I talk to, they had a hard time coming up with 1 income stream, much less 3. So I knew I was onto something. And so the follow-up questions were, well, why are you struggling to accomplish financial independence? Can you describe to me what is the issue? And they invariably went down one of 2 paths. The first path, which was more evident amongst everybody, which is a lack of financial literacy. Literally, people grow up in their household. Very few families talk about money very much. They go off to college, they start their careers, they do whatever they do professionally, and nobody ever really focuses much on wealth accumulation and financial topics and investments and budgeting and just basic things you would think about. So
Because we focus too much on salaries here, and at least in the States, we focus on salaries and we focus on consumption, and we don't talk about
that
money
is
at work. And so it's no wonder that just lack of literacy, lack of education is rampant.
That is absolutely correct. And so when I asked them where they got financial information from, because that was the natural follow-up question, they said, oh, well, I worked with this financial advisor, this insurance agent, this, whoever it was that they worked with. And I said, well, tell me about that experience, because that was the industry I came from. So I was inquisitive about it. And the same thread came up, but it wasn't financial literacy. And it was the one that was gnawing at me back when I was in that industry. And it was the fact that everybody comes to the conversation from the perspective of a transaction. If I'm a real estate broker and somebody comes to me and says, hey, I've got a bunch of money I'd like to invest. Well, I got some real estate deals for you. If you're an insurance guy, hey, I got some insurance products that are really good.
Hammer, everything looks like a nail, right?
Exactly right. And I don't have any problem with it. I came from that industry. I it's not like these people are trying to do anything bad or nefarious or, but they do have a bias in the situation. So this concept of having a financial bias and then tying that to a generally illiterate populace is, in my view, it's a disaster. It's a disaster. The vast majority of people have no concept of how to accomplish financial independence. So I said to myself, okay, I can either just ignore this or I can create a program to help them solve this problem. And so I went down that path about almost 2 years ago now and put together a structure for an ongoing program that has a variety of components to it. It's not a mastermind in a traditional sense. We don't get together once every 3 months and just talk about things and then walk away and nobody has any actionable items to work with or there's no accountability. This is a ongoing program where people participate every 2 weeks in a small group setting. It's focused on financial literacy and it teaches them in the trenches things that they can implement in their life, whether they work with an advisor, whether they do it on their own, it doesn't really matter. But there's no products sold, there's no bias involved. It's purely helping them accomplish their financial objectives. Excuse me. And so that's what it's based on.
That's awesome. It sounds like it's exactly what a lot of people really need is they need the insight, the financial literacy from someone who is not. I use the phrase on the chessboard, right? If you're trying to sell something to somebody, you really aren't going to be objective because you're on the chessboard in that set of transactions. If you have nothing to sell and nothing to gain from it other than wanting to provide value so that they retain their membership and continue their membership, if you have nothing other than that to offer, then it opens up the doors a lot more for some real education and some real uh, unbiased evaluation as opposed to the phrase he uses like if you're a hammer everything looks like a nail. If you're going to a guy who works for Fidelity, he's going to probably want to sell you some Fidelity products. The guy who works for Schwab products. The guy who sells insurance, he's gonna might be a broker for insurance and pick the best annuity based thing for you, but that's what he's going to be trying to gear you towards because he's on the chessboard.
Yep, exactly right. And, I was fortunate enough to have come from that industry. So I knew what the missing pieces were. A lot of people that I had conversations with would say something like, well, gee, I have a financial planner. And, we did a financial plan several years ago and I spent thousands of dollars developing it. And so they have the sunk cost mentality, right? And he's investing my money based on that plan and I should be good to go by the time I get to retirement. Yeah, I said, well, let me ask you a question. I don't mean to be, intrusive here, but have things changed in the last 5 years since you put this plan together? Because as far as I know, your financial plan is only as good as the calculations at the moment that you did the calculations. Expectations for inflation. Let's just start there. We could go on and on and on of all the things that have transpired, some unexpected and some expected. So your financial plan is not a point in time document. It is a living and breathing experience that you're having. And so it's quite important, number one, to view it that way. And two, what is the investment strategy? Can you explain it to me that they're deploying? And the conversation would almost invariably lead to, well, they built an allocation for me based on what I need to earn over time. And they did it based on historical data going back to like 1929. And they built this allocation and it's, whatever it was 60/40 or however they put it together. And so they're describing to me all of this. And I said, have you ever read the disclosure at the bottom? It always says past performance is no indication of future results, doesn't it? That's not just because the lawyers decided that they wanted to put something interesting into your document. It's because it's a fact, okay? Just because something did X amount rate of return over a long period of time does not mean it's going to do the same. If the world looks different than the past, then likely the results are going to be different. So there's a lot of myths and what we'll call when it comes to finances and wealth accumulation. And the vast majority of the people in the financial services industry haven't got much wealth to talk about on their own. So at the end of the day, it's kind of like the blind leading the blind. So I'm not anti-advisors because I have some phenomenal friends and contacts in that industry that, are tremendous. in what they do. But the vast majority of people, their extensive experience in the space is relying upon the training that they get in the company they're affiliated with and the licensing. That's it. They have no advanced education, no advanced experience, and that is who is serving the vast majority of middle America.
Yeah, somebody who has like 3 or 4 years experience doing this, what makes you think? I think of myself as an engineer when I had 3 or 4 years of experience, and I learned a lot in the first 3 or 4 years, but I wouldn't trust somebody to buy them by myself, go off and design something, something huge or whatever, and I wouldn't trust them to manage a significant portion of my portfolio. So I think that the training, the licensing is important, but it's at the end of the day, my take on most of them is they're salespeople, and they're trying to match you up with uh, what is the best product in their list of things that they can sell you that you should buy. I
Yeah.
want to ask something
And
because oh, go
oh,
ahead.
sure, go
So
ahead.
no, I was going to
No,
bring
I
into
was just
the
going to mention that I think one of the issues we have right now is this demographic cliff that we're all facing, right? The baby boomers are now, the vast majority are into retirement, and many of them are, either entering or in retirement already. And the advice that they've been provided thus far is all centered around what the historical performance and the experience has been for the last 40 years. And that is completely misguided, in my view. We have not lived in that era since 2022. Fundamentally, everything changed in 2022. Interest rates over the last 40 years, regardless of how much they've gone up and down, have trended downwards, which has created a liquidity function in the markets that didn't exist. And now that has changed. It's fundamentally changed. And so since 2022, these retirees are sitting on large portions of their portfolio in bonds and presuming that that is a safe way going forward. And I have a feeling that that is going to turn out to be a really bad decision because their advisors are not managing the risk involved.
the on that, I know you talk about a strategy that you came up with called the balanced barbell strategy. As we talk about, allocating portfolios and understanding risks and diversity and so forth. Can you just, I know the whole strategy is, probably 50-page document or so, but could you just at the top level kind of talk about what the balanced barbell strategy is and how that compares to like the barbell strategy, which we've all heard about, which basically says like put you have two types of investments, very very safe and very very speculative, and those two at the ends of a barbell. How does the balanced barbell differ from that?
Yeah, so the balanced barbell is not about this barbell strategy as you're describing because people are looking at a continuum from one side to the other as very risk averse and ultra risky on the other end. And that's not what it is. Risk and return are intuitively connected. Obviously, everybody knows that, but function differently in different market environments. It's called correlation, right? So when the markets have a lot of volatility, where things are changing in the market structure, volatility causes correlations to go to one. Everything becomes correlated. It's the old saying, they throw the baby out with the bathwater. So unfortunately, investors don't have a really good understanding of how this all works. And asset allocation is something that's very, very misconstrued, in my view. So the traditional asset allocation revolves around traditional asset classes, things like bonds, stocks, cash. Some people would argue real estate. Lately, people have been talking about crypto or Bitcoin or whatever. So there's other asset classes. But none of those can be substantiated historically with the exception of stocks, bonds, and cash. Those are the primary drivers of most of these allocation models. That is not the world we live in and ignores very important asset classes. So I'll give you an example. Precious metals, gold and silver, right? The last couple years have done phenomenally well. And so people would say, well, okay, that's a pretty old fashioned, stodgy asset class. Why would that not have been included in my asset allocation? Well, that's because most people don't get paid for gold and silver allocations, right? If you buy physical gold from a dealer, you pay a commission and it's done. Like you bought it, you own it, it's yours. Your investment advisor has nothing to do with that transaction and he has no way to charge fees on that. Maybe it sounds like I'm trying to hark on, on the advisory world, but unfortunately, the facts are less than 0.5% of all allocations are allocated to commodities, much less precious metals. So if I look at the S&P performance back to the 70s and I compare it to gold and silver, gold specifically, has outperformed the S&P. So how is that a prudent allocation? In my view, it's borders on malpractice from a financial advisory perspective, right? But it's because there's a lack of understanding. The advisor that is being licensed to sell equities in the markets, how much education have they had in the commodity space? Do they even understand how the commodities work? So I'm just giving you one example. So to get back to your conversation of how the balanced barbell works, there is built-in non-correlated buckets of assets, okay? So all of these different asset classes we're talking about could be included in any of the buckets, but the guidelines around the bucket weed out all the things that don't fit. So on the one hand, you have a safe and secure bucket, and the safe and secure bucket is just like what it sounds like. It is safe and secure. The only things that go in there are cash or cash equivalents, emergency funds, precious metals, and things that have intrinsic value, low volatility, and generate maybe some income. Short-term treasuries or bills, would fit into that category, right? So that would be one bucket, and there's not much to tinker, and most investors can actually manage that bucket on their own, right? On the other side of that barbell is what we call the speculative bucket. And the speculative bucket has things like crypto, has things like private company equities that they might have bought into something, something that is very highly speculative but has a great upside potential, right?
Early
But
stage
it could go to
venture.
zero. Any of those things could fit into that category, right? Now, not to say that any particular asset is advisable, because this is not personal financial advice. It depends on the person's situation. What can they actually include in that bucket? But what's important about this conversation is that both the safe and secure and a speculative bucket in my strategy is required to be in balance. That's why it's called the balanced barbell, right? So if you have 10% of your wealth in the safe and secure bucket, you can put 10% of your wealth in the speculative bucket. And even if the speculative bucket blows up completely, like you made terrible decisions, 90% of your wealth is never exposed because it's completely outside of that bucket. It is not managed in the same way. Now, if somebody's very conservative and they've built a large cache of these safe and secure investments in their safe and secure bucket, they can afford to take on more risk. So if the safe and secure bucket grows to 25% of their allocation overall, they can then take a 25% more speculative position because they have an offset. That's why the balance is so important. It's not about the allocation model and historical performance. It's the thesis behind why are we segregating these funds for these purposes. And then there's two other components to this, which is the all-weather portfolio and the dividend portfolio. And both of those are just like they sound. One is a foundational capital appreciation driven portfolio, and the other one is a portfolio that's focused on income and dividend performance. Now, we're using terminology here that is all based on financial markets, but we're not talking about financial markets when we talk about the balanced barbell. We're talking about all asset classes. So if somebody owns real estate, that would be definitely included in these buckets. If somebody owns private equity, it would be included in certain buckets, right? So there's a liquidity issue that most people face. Each bucket has a requirement for liquidity, independent of anything else. So you should never have more, in my view, more than 50% illiquid assets in any single bucket. So those are the general broad strokes of how it works. And if somebody is managing their wealth in this fashion, they can moderate risk very easily, and they can outsource different functions within the, some people want to manage all of it themselves, and that's okay. But a lot of people, they have an advisor and they want their advisor to manage that portion. So if you have an allocation of 30% to the dividend portfolio, it's or should be very clear based on a document that we create called the PIPS document inside of the strategy that you can hand directly to an advisor and say, this is what I expect from you. This is what I am looking for you to do for me in managing this portfolio. Is it reasonable? Can we accomplish this? Are you able to do this? If you're not, tell me, because then it's not the right relationship, right? And they can do that for any one of these portfolios, but generally the safe and secure they do on their own. Sometimes the speculative they do on their own because they can have opportunities or things that they think they can take advantage of. And then the other two portfolios, it's up to them whether they want to.
One of the things you said is, and in my discussions with people as well, I continually bring up as also is the aspect of liquidity. If you think of like most people, most professionals today, where are their assets? Number one is probably their home, and number two is their 401k. And that might flip a little bit as they get a little bit farther on their career. They may find that the 401k now exceeds the value of their home. Those are typically the big two. Neither of those are liquid. I guess you could sell your house if you wanted to. That presents a whole other set of problems about where you're going to live, and is the market depressed at the time, or are you going to be taking a big loss in value on that? Similarly with the 401k, you can get access to that, but it comes with huge tax and penalties that go with it. So fundamentally, the way most people are approaching things with the traditional retirement of a 401k and the propensity to buy homes here in the States leads to a lack of liquidity. And I think that what that leads to, and I think you'll agree with me on this, is like now if some opportunity presents, you have nothing to take advantage of that with. You're precluded from taking advantage of an opportunity which may very well occur during economic periods of turmoil, like we will probably see, that you won't be able to take advantage of that because you have no liquidity.
No, it's absolutely correct. And there are a couple things that I'd love to touch on with regards to this, because I think there are some problematic issues even beyond just the pure liquidity aspect. So I'll start out by saying I have a quote up here on the wall from one of my mentors, Rick Rule, and he loves saying this: when your outgo exceeds your income, your upkeep becomes your downfall. And I think part of the problem with a lot of people is they don't think about what their situation, their whole overall financial situation is leading them to. So they have a good income. They're taking their pre-tax dollars as they should and putting them away in 401k plan. They're spending the vast majority of their discretionary income on lifestyle, and they're not diligently putting away money every single month after tax into a fund to first fund the safe and secure bucket. Now, their view is, I have equity in my home. I can take a loan against my 401k. They come up with all kinds of machinations, including the fact that, I have $100,000 in open lines of credit, either against my home or my credit cards or whatever. If an emergency happens, I can take it from there. Reeks of the delusional mindset we talked about earlier. That is not an effective way to manage wealth, accumulate wealth, and it's just not prudent in my view. First is there has to be a plan in place on autopilot that literally pay yourself first. You are taking a portion of your income and dedicating it to a fund to accumulate funds for emergencies, for future investments, and that is where everybody starts, with the safe and secure bucket. Then once you have enough in there, and that's dependent on the individual, now we can talk about, okay, well, what other options do we have to start building out the other buckets? And that's the all-weather portfolio, the dividend income portfolio, and hopefully if they filled that out, okay, because they do have those already in their plan with their 401k plans, right? They can utilize some of that as part of that planning. Now they can go and invest in opportunities that are speculative, like we talked about earlier, right? So this is how it needs to function. Liquidity is always a concern, and every bucket should have liquidity available to them. And you should never view, in my view anyway, your primary home as an investment. Your primary home is your home, okay? And you don't want to have to sell it because times are bad. But I do want to bring up what I consider is actually a bigger problem for professionals, because the vast majority of their wealth is in their 401k plans. They have no control over the selection of the investment options in that 401k plan. All they know is I can contribute X amount of dollars, I might get this much of a match, and I get to pick from this menu of funds, whatever it is. And I have no control over what is in those funds, when they get purchased, how are they managed. I mean, there's broad definitions, very broad, about what is the purpose and outcome of these funds. And there's obviously a track record that they're going by. Here's where the problem is. Almost invariably, the vast majority of these funds are designed to be low cost. They're using what's called a passive approach to investing. They're using either an ETF or mutual fund structure to access these managers, and they're trying to minimize the cost. And the story has been for the last at least 15, 20 years since John Bogle came up with it, is that passive investing is less expensive. We have historical performance that shows that active managers do not outperform, and therefore you should just buy the index, and this is the way to go. And that's what the vast majority of pension funds are built around. 401k plans are all the same. The problem here is that almost all the trading that is done in these programs are completely algorithmic. They're completely automated. Okay. If you send $100 into the 401k plan for this pay period, they receive $100 million from all the participants. They have to invest that money. There is no thought process involved of, okay, well, which areas of the market should we invest in? Which companies are doing well? What, you might believe in AI, and that's a great theory. AI companies are going to be a wonderful investment, so let's put our money there. You have no control over any of that stuff. You have no idea. So the manager takes the funds and they put it into whatever the S&P 500 index is invested into, as an example. Let's say that's what the fund is based upon. And it's completely algorithmic. So no thought process involved. Nobody cares what price you're paying for that transaction. And so invariably, there is what we'll call a bid to the market. Okay. There's always a buyer standing there to run the price up, because these monies are being contributed every week, month, into these plans.
And they have
That's
to use those funds. It's
right.
part of the thing. They can't keep them in cash because that's not part of the disclosures for that particular fund.
That's right. So it's like, think of a balloon that somebody's blowing up all the time and keeps putting more and more into it. Now, here's the problem. On the way up, nobody's complaining, because the funds just are adding to the performance of the underlying index. And so this is all great news. Now, back in 2008, when we had the last market upheaval, the majority of funds that were in this kind of a passive investing mode was quite limited. It was less than 20%. Today, it's over 50% of the market funds that are invested in this fashion. So what does that mean to you? On the way up, it's great. It keeps pushing the market values up. Why do we see markets at all-time highs? The problem here is what happens when it doesn't? Because someday, nothing goes up in a linear fashion. Someday that changes. And that passive flow that went up is going to go down, and it's going to go down in a very, very significant way. These are not my opinions. These are opinions of much smarter people than me, people like Mike Green and others that have studied this to a great extent. So the concern I have is that most mutual fund investors or indexed investors through 401ks are passive in their approach, not passive in terms of the underlying investment, but they look at their statement once a quarter, sometimes never. They might review at the end of the year, did I make any money or lose any money? Let me tell you, that is not sufficient, because when that market goes down and you're down 40 or 50%, it's too late. It's too late to reallocate. It's too late to make a decision about anything. And I think there's way, way too many people that are in the working world today relying on their 401k plan that it's going to be there for their retirement, and completely exposed to unnecessary risk and have no context of how to manage it and how to get out of that situation if they see a problem coming. And the problem will come. It's just a question of when. We don't know. Nobody can predict the future.
I think that yes, and not only are they not looking at the portfolio often enough, they're not looking at the other the indicators as well to know that a problem is on the horizon, or even that we're in one right now. And then what you mentioned earlier at the start of this segment was that when you're in a company-sponsored 401k plan, the number of knobs that you have is extremely limited, right? You basically have a handful of different mutual funds that you can choose from. Maybe that changes a little bit with we could talk about this another time. The whole, can private equity be put in 401k plans and so forth? I know you and I have had some discussions on that, but you have the option of like mutual funds or cash. That's it. You can basically pull out and put into cash, but you can't. There's not like, oh, I'm going to move this into a different type of asset that is predominantly independent, or at least mostly uncorrelated from the public
Yeah.
markets.
Yeah. Your point earlier is very important here around liquidity, because had that participant been smart enough to put aside safe and secure liquid assets outside of the plan, they would be able to utilize that to actually hedge their prospective losses, let's call it that way, within the plan. And you can do that very effectively. And that's part of the balanced barbell approach, is how do we hedge the risks that we see coming when they show up? And what's fortunate is that the markets are quite sophisticated today. The vast majority of tools that exist today didn't exist the same way back in 2008. People couldn't protect themselves, and that's why their 401ks became 2Ks or worse. That is no longer true. We have all kinds of tools that you can use in the financial markets to hedge these risks out, but you need to know how to do it. You need to know how to make the calculations. You need to understand how these tools work, because if you use them inappropriately, they will actually hurt performance. But that's what individual investors need to do. They need to take responsibility and control of their financial future, and get educated enough so they can make these pivots when they are necessary, because they're going to be necessary. Just a question of when. The perfect example of this is right now is I'm talking to a lot of people that have been involved in the commodities trade in precious metals, and they love it because it's gone up over 100%. So they're making money and they're thrilled and excited about that. And if they have any extra cash, they want to keep throwing it into that. And I tell them nothing goes up in one direction always. At some point, there will be an adjustment. I am super bullish on precious metals on a 5 to 10-year time horizon. But between now and then, there are going to be vast volatility going up and down in both directions. Now, you can either just say, I'm going to ride through it and don't care. I'm going to close my eyes, even if I'm nauseous, and it doesn't matter. Or you can say, I'm going to hedge out the opportunity when it comes, when I can see that there's a, tsunami coming because there's an earthquake somewhere else, right? The tsunami's on its way. I'm going to buy some insurance. I'm going to offset the risk. I'm going to hedge this out. And then when that insurance pays off, I'm going to reassess my situation and take the capital that came from that and redeploy it into the asset that has now depreciated on the other side, right? And so I might buy more precious metals with that, if that makes sense. But I can't make that decision now, and I don't know if the insurance is going to pay off. The goal is, how do you make that equation? So I'm hoping that a lot of the advisors out there are clued in enough and understand how to do this and are proactive with their clients and paying attention, and they're going to help them do this. But again, who's the advisor in your 401k plan? Like, there is none. So you are it. So what are you going to do when it comes to your, wealth plan? That's why I built Wealth Counsel.
So we're going to move into some rapid fire closing questions here, but I think probably what a lot of people are thinking right now is Wealth Counsel available for anyone to get into? Do I need to be an accredited investor to join? Does it cost $50,000 a year to get in there? If you can give us just a little bit of, we don't do a lot of like marketing and promos and stuff on this program, but it is something that I think many people may be interested in learning a little bit more about. Can you just talk about that for a second?
Sure. Yeah, so I'll touch on a couple things with regard to this. Number one, it is nowhere near $50,000. It's not that kind of a program. This is an educational program by its nature, and it's very inexpensively priced, in my view. A lot less than you'd be paying any advisor to help you manage a portfolio. Currently, the pricing is $3,600 a year. It's one flat fee you pay for the year. And if at the end of the year you don't want to renew and it doesn't bring you value, then you don't participate going forward. But I will also tell you that one of the things that's part of Wealth Counsel is we have model portfolio. We don't want people doing this blindly. So they get access to model portfolios for each one of those 4 buckets: the safe and secure, the speculative, all these are included. And the purpose of the model portfolios is not for them to simply copy them and invest into the items that are in there. The assets that are in there are being selected specifically based on what's going on in the markets today, right now. They're live model portfolios that are changing. And so it's to give them context. It's to give them a way to compare returns that they're getting in their own investment portfolios. If they're matching the balanced barbell, it's really easy to see how am I doing with my safe and secure relative to the safe and secure that Wealth Council publishes as a proxy. That's one part of it. The other part of it is we've been running this as a beta test. So it has not been open to the public, and it won't be open until after the first of the year to the general public. The beta
First
test,
of 2026.
2020. That is correct. Yes. First of next year, 2026. When I put this together, one of the things that I decided to do was I wanted to have a portfolio that we could use to track internally, not a model portfolio, but a portfolio to show people what is possible, right? And we would use it to educate the community and the groups that are involved. So we put this portfolio together, not knowing how it would turn out. And I decided early on that I needed to do this as a live portfolio, meaning I put my own money into it. I didn't want to do a paper portfolio with hypothetical positions. And the reason why is because when you don't have any real money at stake, you make frivolous decisions. So I wanted to make sure that if I make a bad decision, it's going to cost me. If I make a good decision, I'll benefit, and I'll share fully transparently with the group what I am doing, why I'm doing it, how that works. We've been very fortunate that we've done well over 200% in this last year. I mean, it's a phenomenal situation. I couldn't have asked for a better result, and it wasn't because of my genius. I promise you, a lot of it was luck. But the fact of the matter is, it's done extremely well, and we share that with the group. And I bring that to the table not because it's been such great performance, but to give people an understanding that if in their mind, the cost participating in something like this is not valuable enough, you're not the right participant for the program. You don't get it at that point because the cost is inconsequential. You can make that up in literally one transaction. It's about understanding how you're going to build financial independence in your life. And we cover all kinds of topics. It's not just the financial markets. I mean, we cover insurance topics, we cover asset protection topics. We don't touch taxes very much because we don't provide individual tax advice, financial advice, or legal advice. We're an educational pursuit. But that being said, we do provide a lot of information that our members can then put to work. So cost generally is not an issue for most people that want to participate in the program. Like I said, we will be launching it publicly beginning next year. And so anybody that is interested can certainly get in touch with me and we'll have a look and see if they're a good fit for the program. We don't accept everybody, just to be clear. It's very selective, and it's not selective based on how much money you have or anything like that. The criteria for being a good participant, somebody is intuitively interested in accomplishing financial independence. They understand the thesis behind what we're doing and why we're doing it. And they're an active participant. Who's not a good participant, as we've had some of those too, are people that sign up for the program and then don't show up every 2 weeks. They don't actively participate. They don't do anything with their education in between the 2-week sessions. They don't communicate. They don't provide questions and things related to their own situation. And I find that those people don't get much value and they just drop off. Always wondered in my life why people make a financial commitment to something and then don't follow through. But I've given up on trying to understand why that happens.
Because the pain stops when they join. Right. Then, and once they've joined, then they think that they've taken an action to help solve it. It doesn't really solve the problem, but at least they've taken an action. At that point, they move themselves from if you're a Kahneman fan, like a system 2 to back to a system 1 type thinking, and then they go along back on their merry way and they work to the next thing that's causing them pain. And it won't be until they think 8 months, 9 months, 10 months later or whatever, like, hey, I never actually went to that thing, and it didn't really, I never showed up for a meeting, and it didn't really solve any problems. And then now they're back in pain again. They'll have to figure out, well, do I actually start going? Do I cancel and buy something else or whatever? I want to hit
Yeah,
in like
I
a
think you're
couple.
right.
Oh, go ahead. Go ahead.
No, I was just gonna say, I think you're right. I think it's the financial pain that they incur for joining the program is so small relative to the pain of having to actually do the work, having to actually not only show up, but do the homework. Like these are the people that probably went to school and spent most of the time outside of class partying or wherever they did because they weren't serious about what they were doing.
Okay, a couple rapid fire questions here. What's one piece of common career or financial advice that you think is just totally wrong?
I'll start with the career, which is I think that people say follow your passion, figure out what your purpose is and go do that. I think that's wrong. I think that, there's a lot of things in life that I'm passionate about, but I'm not very good at it. I think people need to figure out what they're good at and go do what they're good at. If I was a much more patient individual, maybe a different type of a leader early on in my career, I might have made the choice of going up the corporate ladder and doing that role because I had that opportunity. But I chose not to do it because I realized it wasn't me. I wasn't going to be happy doing that, what I was good at. So I think it's really important. If you want to be successful in life, figure out what you're good at and do what you're good at.
Excellent. Okay, pay it forward. If you could teach every professional just one lesson on money and one lesson on their career, what would those be?
Oh, okay. Well, let's take the money side of the equation. I think inherently people understand that risk and reward are related to each other, clearly. But I think the biggest misconception with regards to risk is they don't understand how to evaluate risk. And so their idea of risk is, well, can this investment generate the return that I'm looking for? What's the probability of that? And I always say that you have to look at the other side of that coin. And that is, what's the probability that this thing fails? See, if you take care of the downside and you understand, the upside will take care of itself. So understanding what the risks involved are, what could cause this investment to go south on me? Can it go to zero? If it can, why? Can I mitigate any of those factors? That positions you for a completely different thought process with regards to the returns. And I never worry about returns because I probably wasn't attracted to the opportunity if the returns weren't significant enough to begin with. I worry about what can go wrong and where can I lose money because I hate to lose money. And every wealthy person I've ever been around hates to lose money. Doesn't matter how much, even a little amount.
And it's such a setback, right? You lose, something happens, you lose 50% of the value of your portfolio. Now you have to double it, which we know how difficult that is. You have to have 2x to get back to where you were before. And
That's right.
so I think that's just we don't think of, all we think about is like the upside. We don't think about the downside and the protection of that. We may find that this investment may have a fantastic upside, but it's got such a tremendous downside that it may not be worth it, at least in one of the particular buckets in your
No,
portfolio.
you're absolutely correct. And this is exactly the premise behind the balanced barbell strategy, right? Is that you'd have to really be stupid and work diligently at screwing yourself up following that strategy. What bothers me in the markets today, and I'm not going to mention who this individual is because he's a very successful investor. He's very well known in the marketplace for being a successful investor and can't take any of that away from him. Okay. But what the retail consumer hears and sees is vastly different than what is actually going on behind the scenes. So I listened to a podcast that this investor was on, and he was talking about all of his successes and everything that was going on. And it was great. I mean, learned a lot, great podcast. But somewhere along the line, they asked him to provide some advice for people. And so he started spewing the traditional advice about passive investing and index funds and blah, 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 all things we talked about earlier. And I'm listening to this and I'm saying to myself, holy crap, this guy is so full of shit. He's full of shit because he's telling them exactly what he doesn't do. Because I know what he does. I know what is in his portfolio because it's reported to the SEC. All you have to do is pull up the SEC records. You can see what he's invested in. And he's currently invested in 5 companies, which is a very concentrated position in a singular sector. And to the tune of 338 million. I have it over here. What the message that I'm saying here is, I think the investments he's actually making are very good investments. And he's very sharp. And they're going to pan out for him. And I know exactly why he's doing it, because he has an asymmetric opportunity. He's investing in a sector that is unloved right now, that is inexpensive and has a huge upside. And the downside is almost zip. It's almost nil because all 5 of those companies, if they were to liquidate tomorrow, the value of their assets is greater than their market value. So he's very thoughtful about what he's actually doing. But if you listen to the podcast and you think, well, wait a minute, that's not the way to go, because he's telling you something completely different. That blows my mind.
Interesting. So can you share what sector that we should look at?
Well, I'm not suggesting that this is a sector that you should look at, but in his case, I just will tell you, he's invested in the offshore drilling space. Invariably, all the companies in his portfolio are not even in the U.S. They're offshore. They're offshore, literally.
Right.
Yeah.
Awesome. Boris, you have given us a ton of useful advice and a lot to think about. How can we get in touch with you?
Best way is just my website. You can put in a request through there. It's borisblum.com, borisblum.com. My email address for my consulting company is boris@my-ceo.com. If for some reason I don't get back to you through the website, you can certainly do that as well. We are publishing in the beginning of the next year a new publication called Perspectives, and it is my take on where I think the world is headed, and specifically the financial markets. It's absolutely free. If anybody wants it, they can just sign up on the website for Perspectives and they'll get it. There's no sales pitch or anything tied to it. It's purely informational.
Awesome. Boris, thank you so much for all the super valuable advice you've given us today.
You're welcome. I enjoyed it thoroughly.
Awesome. Okay, everybody, we'll see you next time on Thrive and Achieve, where professionals help professionals thrive in their career and achieve financial success. Have a great day, everybody.